In today's video, I'll be showing you the investing tax loopholes that the rich use to get even richer. One of the biggest secrets of wealthy investors is how they use these perfectly legal tax loopholes to keep even more of their investment returns. And as a certified financial planner, I've watched wealthy clients consistently use these strategies that most people didn't even know existed. That's exactly why I'm making this video today, to reveal the tax loopholes that wealthy investors use to maximize their after-tax returns and build wealth faster. So strategy number one, using your health savings account as a long-term investment account. This is the most tax advantage account. You get a tax deduction when you fund it. Your investments are growing tax deferred. If you use this money for qualified medical expenses, it's tax-free distributions. And here's the catch that most people don't even know. When you fund an HSA through your employer plan, you additionally save payroll taxes, right? The 7.65% payroll tax that you're paying for Social Security and Medicare, don't have to pay it if you fund your HSA through an employer plan. And so the strategy here is that you are letting this money grow and compound for years, decades, while you are paying for your medical expenses out of pocket, cash. Right? And you can only use this strategy if you have a high deductible healthcare plan, right? So obviously, situationally depends on if that is the best healthcare plan for you. Now, I can only cover this strategy in a small amount of detail because I have to move on to the next one. However, I don't want you to walk away from this video with any unanswered questions, which is why I'm offering a complimentary call where we can review your situation and help you optimize your tax plan. All you have to do is click the link in the description below to book a call. And with that, we'll get back to the video. All right, strategy number two, backdoor Roth contributions. Why do we call it the backdoor contribution? It's because once you make a certain amount of income, you're not allowed to make a deductible contribution to your IRA. However, you can make non-deductible contributions to your IRA. And if you're going to be taxed on this money anyways, right, because it's after-tax money that you've gotten from wages or earned income, if you're going to be taxed on it anyways, why not shelter some of it for long-term growth, right? So you make a non-deductible contribution to your IRA. You then convert this money to Roth, and now the growth of this money is forever tax-free. Now, there is some nuance here to the strategy. You do not want to do this strategy if you have other IRA money, because then when you convert, you can't cherry pick the after-tax money, right? You have to prorate the money that's being converted in all of your IRA balances, simple IRA, SEP IRA. So you only want to do this if you don't have any other IRA monies. Now here's the strategy. If you have IRA monies that are pre-tax, you can move it into your employer retirement plan, your 401k, and now you have zero IRA monies, which allows you to cleanly do this backdoor Roth contribution. The non-deductible to the IRA, convert it to Roth, forever is growing tax-free. Now, you have to report this on Form 8606 on your tax return, and that's where you would see, if you had other IRA monies, you would see that proration calculation. That can make it messy where you have to track basis every year. So by not having the other IRA money makes it so you don't have to track that basis every year. Strategy number three, this one is huge, especially for those pre-Medicare retirees. This is called the premium tax credit. Now, these tax credits are for people who have health insurance through the marketplace, right? So if you retire at 55 and you have 10 years before Medicare, you have to figure out your healthcare plan. Well, these healthcare plans are not asset-based, they're income-based. So based on where your income is in your retirement accounts, we can control your taxable income to help you qualify for these tax credits and get you subsidized healthcare as a multimillionaire. Now, we see this all the time. And in fact, one of the strategies that pairs really well with this is Roth conversions, because we can generate the amount of income that we need to pulling money from an IRA, converting it to Roth to get you into the income level that maximizes your premium tax credit while still thinking of long-term tax savings, getting money over to Roth that's growing tax-free and you can pull out tax-free. Not only that, it's also lowering your future required minimum distribution amount. Eventually, the government's going to push money out of your retirement account saying, hey, we've given you the tax deduction and the tax benefit for all these years, and we want our tax revenue. And for some investors, especially those who are good savers, their RMD, their required minimum distribution, may be more than they want to take out of their account from their spending needs. And so that's where we have this great decade, or this period of time post-retirement, before Medicare, before RMD, where we can do these Roth conversions, get the premium tax credit. Super, super great tax strategy, help you maximize your after-tax spendable dollar. Next tax strategy. 1031 exchange. Let's say you have an investment property. This is to help you move from one investment property to another without paying taxes. Now, this sounds too good to be true, but if you have an investment property that has appreciated greatly over time, if you were to sell that and buy a new investment property, that's a taxable event. However, you can 1031 exchange one investment property into another and you're deferring taxes, and you can keep the strategies to keep deferring taxes until you die, because then your heirs receive a step up in basis and can now sell that property without having to pay tax, because the fair market value is now the basis, and so essentially there's no gain to be taxed. Bonus strategy. This comes to charitable giving. So for wealthy investors who like to donate money they would give anyways. Again, charitable giving is not a wealth maximization strategy. However, if you're going to give money anyway, say a church or a nonprofit that you care deeply about, there are no wealthy investors that are paying cash, right? They're doing a few things to maximize their gift and minimize the taxes of that gift. And so number one, if you are over age 70 and a half, you can send money straight from your IRA to the charity, and that's called a qualified charitable distribution. You are not paying taxes at all on that distribution. It's completely avoiding your income. Now, the opposite of that, if you took that distribution from your IRA, then paid cash, well, you've now recognized income, and at best you have a charitable income deduction, but that only benefits you if your charitable income deductions and all of your itemized deductions are larger than your standard deduction. So again, QCD, qualified charitable distribution, send it straight to the charity, avoids taxation completely. Now, let's say you're not 70 and a half, you're younger than that. Well, that's where donation in kind makes a lot of sense. You can donate appreciated stock to a charity and they can sell it, not pay any taxes on the gain, and use the cash. You got double tax benefit right there. You didn't have to pay taxes on the gain, and you got a charitable itemized deduction, which, if you can lump together with other itemized deductions, can be larger than the standard deduction. So let's say you regularly donate to these charities, you can lump those strategies together into 1 year, get enough charitable deductions to itemize that year, take the standard deduction, and then just rotate. You're switching every single year. So that's kind of combining a few strategies into one. Now that you know the tax loopholes that wealthy investors are using to multiply their wealth, you need to understand one thing. These tax advantage investment strategies are just the beginning of what's possible. The truth is, I meet with investors all the time who are missing out on thousands of dollars just because they don't know. If you want to further optimize your personal finances, click the first link in the description to book an entirely free call with me where I'll sit down with you and help you optimize your finances.